have holding up the market is the bottleneck that's out there. Sellers don't want to move from their apartment or their home because they don't want to take on higher interest rates, and buyers are too afraid because they're getting less house. And right now, what everybody's afraid of is the high interest rates. But the minute those interest rates come down, all hell's going to break loose and prices are going to go through the roof. But they're not going to stay put if interest rates go down by 2 points. It's going to be a signal for everybody to come back out and buy like crazy. And the house prices, I would not put it by the housing market that prices go up by 20%. We could have COVID all over again.
So that was real estate mogul Barbara Corcoran just a few days ago on June 1st on Fox News. Now, I don't know if Barbara watches this channel, but here's what I said a month ago on May 8th. But be careful about waiting too long. Whenever rates finally hit, say, 5% or less, you're likely to see a ton of back pressure from all these sideline buyers. We could easily see an explosion of activity next spring. And this could lead to crazy town, multiple offers, and the same cycle we've seen twice before just in recent history. Sounds quite familiar, huh? Well, today I'm going to break down all the analytics you need to know and illustrate why Barbara and I are seeing the same impetus take form. So stay tuned as I attempt to break down this peculiar real estate market. Okay, first up, let's see how last month's sales went. Once again, we had a very disappointing month with only 2,054 sales in May. This was a 25% decline from last year. Now, in reality, this number is even worse than it looks. Typically, we sell right around 3,000 homes in May. So really, sales are about 1/3 below the normal amount. So with sales in the dumpster, that naturally means that the median price had to decline a bit, right? I mean, at least a little bit, right? Well, check this out. As you can see now, the median price actually blew up last month by over $15,000 to wind up at $440,500. So let's unpack some of this lunacy. Since February, our median price has risen over $25,000. This in spite of declining sales. Now, the peak of our market was in May of last year when we hit $485,000. Every month thereafter, we started seeing price declines. Now, right now, we're already above the median price in October of last year. At the rate we're going, we should see parity in the median price sometime around August. Hell, even the median price, if it stays flat for the entire rest of the year, we'd end up about 5% above the median price last year. So try and wrap your head around that one. All right, next let's check out our most important indicator, current inventory levels. On the screen now, you can see that we managed to continue our decline in inventory. We ended the month with just below 3,500 homes on the market. Looking back to 2019, before all this lunacy began, we had more than twice as many homes on the market back then. This also marks 31 straight weeks of declining inventory. This is the longest streak of declines in over a decade. The previous record was 25 weeks at the end of 2020, right after the pandemic, because the market caught fire and inventory couldn't simply keep up with the demand. This, however, is a completely different beast. Now, before we wrap this up, let's check out housing absorption by price range. This tells us how different price ranges are performing. See, the higher the percentage amount, the more in demand and therefore competitive that market segment is. So let's start off with the bulk of our market, homes priced between $250,000 to $500,000. This increased by 3% to land us at 52%. So over half of the homes in this price range are already under contract. Next, we have homes priced between $500,000 and $750,000. This increased slightly from 36% to 37%. Next are homes priced between $750,000 to $1 million. Another marginal improvement from 31% to 32%. All right, now let's talk luxury, $1 million to $1.5 million. This increased from 22% to 24%. finally, the ultra luxury market of homes priced over $1.5 million. This was the only price segment that actually remained unchanged at 18%. Now, when we look at the market overall, we're now sitting at 42% saturation. For some context, we started this year at only 21% saturation in January. In just 5 months, our market has become twice as competitive. So just let that part sink in a little bit. All right, now that we've gotten past all the numbers, let's attempt to make some sense out of all this madness going on out there. Sales are terrible, but the median price is rapidly rising due to the lack of available inventory. So where is this kooky market going? Look, on the surface, our market seems to be defying the laws of economics. When sales plummet, typically that means prices follow in that decline. But due to lack of inventory, that's the only part of the equation that's keeping us from a continued housing correction. Now, frankly, I don't see our inventory loosening up anytime soon. Ultimately, we're likely to look back at this year as an off year. Somehow, despite massive interest rate hikes, we've managed to keep our property values at bay. But if there's one constant in our lives, it's the fact that change is guaranteed to us. Most likely, this is the peak of our interest rates. I still feel that rates will start to recede towards the end of this year. Now, 6% interest rates are beginning to feel normal to us. Now, once we get back into the 5% range, you'll start to see activity again. But just like Barbara Corcoran alluded to in the beginning of this video, if we see 5% interest rates, don't be surprised if prices jump 20% again. I know it sounds crazy, but look no further than the present. We have high interest rates and low demand, yet prices are increasing. If median prices manage to go up 5% in a market with low demand this year, is it really crazy to predict a 20% increase next year? I don't think so. So for those out there looking to purchase, like I said in the beginning of the year, prices certainly are not going down. With rates and payments so high, perhaps this is the time to purchase with an adjustable rate mortgage. Now, while I hate ARM loans in general, right now it may be the most prudent move. Lock in your property at a fair market value, take the ARM loan with the understanding that over the next few years, you should be able to lock in a fixed 15 or 30-year mortgage and avoid any price appreciation along the way. I mean, it's either that or wait until rates come down to a level you're comfortable with and then jump in. However, if you wait too long, you might wind up overpaying for that exact same property and suffering from a high fixed rate mortgage payment as a result. Not to mention, you'll be fighting tremendous competition. While the market doesn't feel great right now, especially for buyers on the lower end of the market, this might actually be your best opportunity to find a home since you have substantially less competition. Now, next year, those lower end buyers are going to be fighting against themselves along with cash investors that are ready to jump in and ride that wave of appreciation up. Well, that's it for this month, everyone. With all this talk from the Biden administration about racist appraisals, I don't know. I think it's finally time for me to put out my appraisal video. For years, I've been wanting to make a video regarding why I believe appraisals are BS. So look for that this month, along with a bunch of awesome property tours. So please like, share, and subscribe. I'll see you guys all in the next one. Deuces.